Yes, all this talk of cereal and eggs is making me hungry. But I think, when we look at how the economy could sort of play out, and especially through the lens of our active funds, we do find ourselves at, a crossroad. And you've got three potential scenarios. One is inflation doesn't fall the way central banks wanted it to, and that brings back, more than expected hawkishness. What we might see is like a repeat of last year. The other one is the no landing scenario in which, growth stays fine and, inflation starts to roll over. However, both of these scenarios we tend to sort of discount a bit. Now, base case scenario of like what should play out is the baton is gradually shifting away from inflation and into growth. And growth, on the surface has seemed reasonably strong, and people have really not been that concerned about it. But when we actually, our analysis of the U.S. consumer, with reference to the clip you played earlier, definitely shows that while overall the consumer is strong, there are segments within the consumer that is actually not getting very stretched, and that should start to play out. The other impact that we've seen is like high inflation has helped companies keep their margins high. And as inflation falls over and as wage bills start to rise, company margins are going to get squeezed, and that will, contribute to a rise in, unemployment and an unwinding of all the kind of like the perfect conditions that we've seen for the last 3 or 4 months. So in terms of, what this means for inflation is it's the weaker growth that will continue to sort of like bring inflation down. So that's our base case scenario.
How are you playing that through the portfolio?
In terms of our active funds, what we are doing is we definitely have a stronger preference for non-cyclical companies compared to cyclical companies. We are looking for companies that have like strong business models and have the ability to sort of like, pass through prices and, maintain their margins more or less where they are. And in the case of like cyclical companies, because you might see some top line pressure with falling inflation, what you would expect to see is if you have high operating leverage or high financial leverage, then that's going to start telling on the bottom line. So we're looking for companies that have sort of low gearing overall and really stable business models.
Yeah.
Overall, in terms of like, sorry, go ahead.
No, sorry, I thought you'd finished. Please carry on, sir.
I was going to say overall in terms of like different asset classes, the last time I was on the show in October, we were talking about risk premia and how you had like a big repricing of risk premia in 2022. Now we've given a lot of that back, and risk premia are not that attractive across asset classes as they were in October. However, we still like high quality fixed income here because, we think the correction that you've seen is probably better than what you've seen in other asset classes. And so, it's choosing amongst the places where you kind of think, depending on what scenario plays out, you kind of like have the best, premium that's being paid for you, where you can earn some good carry, and where the upside and downside is sort of skewed slightly in your favor. So, high quality fixed income, again, is like something that we prefer.